Welcome to the Nifty Noon podcast. We are doing a deep dive today, looking at, 5 days of pretty incredible market history. Our source material is the Nifty Noon newsletters, specifically from November 17th through the 21st. And the mission here is really to trace one of the most volatile weeks in recent memory. It swung so wildly from this unprecedented institutional acceptance to just sudden, brutal whale capitulation.
It really was. And it was the week that kind of captured the industry's whole identity crisis.
Yeah.
You saw evidence that crypto was getting fully integrated into, the highest levels of global finance. And then almost immediately you get proof that its technical infrastructure is still fragile and the market is still very subject to panic.
Absolutely. So to give you the rapid overview, the TLDR for the week, it really hits 5 key points. We start with massive institutional validation, think Harvard's big Bitcoin bet. Then we get this push for mainstream DeFi access through Aave's new app.
Right.
And that optimism just slams into a huge centralization vulnerability with the Cloudflare outage. Next, we saw major crypto infrastructure, Kraken, moving toward the public markets. And finally, it all wraps up with a sharp market crash and this OG whale dumping that really defined the Friday. So let's unpack this, starting with Monday, November 17th. If we had to give that day a title, it would be Institutional Mega Validation. The big story was Harvard University. Why was their move such a powerful signal?
Well, it's the sheer weight and the conservative nature of the institution itself.
No.
Harvard manages the largest academic endowment in the world. And endowments like this are built for, multi-generational stability. They're famously cautious.
Okay.
And according to their 13F filing, they increased their stake in BlackRock's Aave spot Bitcoin ETF by a staggering 257% in Q3.
Wow.
That volume alone is shocking.
And it's not just the percentage increase, right? It's the resulting portfolio allocation. They now report ownership of 6.8 million shares, valued at nearly $443 million as of September 30th.
And this is where it gets really interesting for you, the learner. This IBIT position became Harvard's largest declared U.S. stock holding. It surpassed established multi-trillion-dollar market cap companies.
So they owned more of a Bitcoin ETF than they owned of Microsoft or Amazon or even the SPDR Gold Trust.
Exactly.
That feels like a fundamental strategic capital reallocation. They're moving away from established assets and into digital ones.
Precisely. They are explicitly saying they value access to Bitcoin more than the traditional giants of tech and, as you said, the classic inflation hedge, gold. This move isn't based on some meme excitement. This is based on a deep, long-term fiduciary duty.
And they chose a spot ETF.
Yes, and that's critical. It shows they want direct exposure to the current price action to the asset itself, not some complex discounted futures product.
And this wasn't just a one-off, right? Our sources also flagged that this was part of a bigger trend.
A much bigger trend. Emory University and a significant Abu Dhabi sovereign wealth fund also substantially increased their spot Bitcoin ETF holdings in that same period. It's a clear signal that the due diligence is done, the compliance boxes are checked, and this generational capital is actively re-rating Bitcoin as a required asset class.
Okay, so let's pivot. From the deep pockets of traditional finance to the potential everyday user. Tuesday, November 18th, was all about retail outreach, with Aave Labs making a serious play to bridge DeFi to the mainstream.
Yeah, Aave Labs launched a consumer-facing app right on the Apple App Store, and the strategy is just brilliant in its simplicity. They're calling it DeFi in the back, fintech in the front.
So they're trying to solve the biggest hurdle for crypto adoption, which is just how complicated it all is.
Exactly, the cognitive overhead.
They swapped out all the intimidating language. You don't see words like protocols or staking stablecoins.
Yeah.
The app just looks and feels like a Chime or a Revolut, a clean, simple neobank.
And they're offering really compelling incentives that, appeal to the mass market. A base yield of 5% with potential for rate boosts. But the real game changer is how they dealt with accessibility and, more importantly, risk.
The risk question is everything, especially for people who have their savings in a 0.5% yield account at a traditional bank.
Totally. So first, they accept deposits via standard bank transfers, debit cards. It removes the need for a crypto on-ramp. But to really target that risk-averse capital, they publicly emphasize that they offer insurance-backed protection up to $1 million on deposits.
Okay, that sounds huge. But we have to be technically precise for our listener here. When we hear $1 million insurance, are we talking about FDIC protection or is this something else.
That is the most critical distinction. This is not FDIC insurance. It's not backed by the U.S. government. This is private, decentralized insurance, usually from a protocol like Nexus Mutual or something similar.
So the coverage is backed by collateral that's pooled by other users.
Exactly. Not a sovereign entity. It provides huge psychological reassurance, and it shows a commitment to mitigating risk. But you have to understand the protection is only as strong as the collateral behind it.
That nuance is vital. They're clearing a psychological hurdle, but they're using crypto-native tools to do it.
It shows DeFi's growing maturity.
Yeah.
Oh, and before we jump into Wednesday's chaos, we should mention two other massive data points from that same day.
Right. Michael Saylor's MicroStrategy, always a bellwether for corporate BTC buys.
They purchased a staggering 8,178 BTC.
And then there was regulatory progress in Asia.
Yeah, Japan's FSA announced plans to reclassify Bitcoin and crypto as financial products. It sounds like a small bureaucratic step, but it has huge tax implications. It could drop the capital gains tax from a punishing 55% down to a much more manageable 20%.
So you have this perfect storm of optimism. Harvard buying, Aave simplifying, MicroStrategy buying, Japan easing taxes. And then came Wednesday, November 19th. And we just ran headfirst into the centralization paradox. This is where the decentralized ecosystem choked on a centralized platform.
It's the ultimate irony, isn't it? Despite the brilliance of the underlying blockchain tech, the user experience is often filtered through this fragile traditional web architecture. And the evidence of that came when a massive global network outage hit Cloudflare.
So for the everyday user, that just meant 500 internal server error pages popping up everywhere. It cut off access to their services. What actually happened? What caused the meltdown at a company that's supposed to be the backbone of the internet?
It was an internal configuration file.
Yeah.
They have this huge system for managing threat traffic, and that file just unexpectedly ballooned in size. It triggered a service degradation that crashed their whole network.
But the chains themselves were fine.
The chains were fine. The decentralized protocols, Ethereum, Solana, Bitcoin, they kept processing blocks totally unaffected.
But if you can't log into Coinbase or Kraken or Etherscan, it doesn't really matter how well the blockchain is running in the background.
Absolutely. The user-facing front ends for every major platform, Coinbase, Kraken, Aave, ironically.
The one we just praised.
The one we just praised.
No.
Etherscan, Diaflama, they all went down. This incident is just a brutal reminder that the crypto industry's reliance on centralized providers like Cloudflare and AWS creates a single point of failure.
So given that extreme reliance on these services for the front end, can we still call this ecosystem truly decentralized, or is that just marketing hype at this point?
That's the important question this whole thing forces us to confront. The core ledger, the blockchain, is decentralized, yes, but the access layer is highly centralized. The industry knows this is a problem. They're exploring solutions, decentralized DNS, decentralized storage, but until those are fully adopted, this paradox remains the industry's Achilles heel.
A tough lesson on Wednesday. But the market has whiplash, so we swing right back to institutional bullishness on Thursday, November 20th. This time, the focus was on Kraken, and this move for major exchanges to go public.
This is a major sign of regulatory maturity. Kraken officially filed a confidential draft registration with the SEC for a potential IPO debut in Q1, which is basically them saying, we are ready for the highest level of scrutiny the U.S. can possibly offer.
And this move came right after a massive $800 million fundraise, right?
It did, yeah. It pegged their valuation at a staggering $20 billion. But the real story is who is validating that price tag.
Who's backing them?
We're talking traditional finance heavyweights. Citadel Securities, Jane Street, and Goldman Sachs are all investors. These are the institutions that make the traditional financial markets tick, and they're investing billions into the regulatory future of a crypto exchange.
So this isn't just money, it's a huge endorsement. These firms are the gatekeepers of TradFi. Their involvement implies they accept and, well, are ready to profit from regulated crypto.
Exactly. Kraken embracing the IPO process and all the scrutiny that comes with it signals they are prioritizing broad, long-term market share over operating in some regulatory gray area. It just reinforces that institutional narrative.
So after 4 days of staggering bullish news, Harvard tripling down, Goldman Sachs backing a $20 billion IPO, you'd expect the market to be soaring. But then came Friday, November 21st, and the week ended not with a bang, but with a brutal, sharp capitulation.
It was a disastrous 24 hours. Bitcoin tumbled, and it pushed the fear and greed index deep into extreme fear. The sell-off was really characterized by these high-profile exits, which signaled panic across different kinds of investors.
The whole narrative of the crash seems to center on this idea of whale capitulation. Tell us about Owen Gundon. Why was his exit so significant?
Owen Gunnan represents the OG money, a true early adopter. He reportedly held a ton of BTC since 2011, and since late October, he'd been slowly liquidating his entire estimated $1.3 billion stash.
Wow.
On Friday, we saw the final act. He transferred the last $230 million of BTC to Kraken to sell, just as the crash was really picking up steam.
So that's a 14-year holder, someone who survived every single previous crash and bubble, finally saying, I'm out.
It signals deep market skepticism from that veteran cohort.
And it wasn't just individuals.
No, corporate players were dumping too. Our sources noted the NACA ticker dumped over 35 million in BTC. And what was more concerning for the immediate future was data from CryptoQuant. It indicated that institutional demand, the very demand we celebrated earlier, had just evaporated. ETF inflows were way down.
Were there any technical signals that told analysts the market had really moved into a bad spot?
The key technical signal was the breach of a major long-term benchmark. For the first time since early 2023, Bitcoin fell below its 365-day moving average.
And what does that mean practically?
Well, for long-term investors, that moving average is like a baseline for year-long sentiment. Falling below it usually signals that momentum has definitively shifted from bullish to bearish. It makes a lot of long-term models flash red.
And this was all happening in a pretty tough global environment.
It was. I mean, you had strong earnings from NVIDIA, which was some good micro news in tech. But it wasn't enough. The S&P 500 lost $1.5 trillion in value that day. It dragged all risk assets down globally, and crypto, of course, just amplified those losses. The Friday sell-off was a massive, painful flush.
What an incredible 5-day swing. We started the week with Harvard making Bitcoin its largest position, symbolizing ultimate institutional faith. And we ended it with a 14-year whale basically saying, this cycle is over for me, and dumping his entire stash.
It really does. It perfectly encapsulates the two conflicting narratives that are navigating the crypto space right now. And it raises an important question for you, the learner, to really think about as you process this. If banking titans are backing Kraken's $20 billion regulatory embrace, and Harvard is making BTC its largest holding, does this whale capitulation represent a necessary final market flush, clearing out the last of the reluctant sellers? Or does it signal a deeper structural flaw that these veteran investors can see? What truly distinguishes the smart money, the endowments buying aggressively, from the OG money that just exited this cycle entirely? The answer to that is going to define the next 6 to 12 months of market direction.
A fascinating thought to mull over. Thank you for joining us for this deep dive into the insights extracted from the Nifty Noon newsletters, and we invite you to follow Nifty Noon on X and Substack.